Oh, wow.
I
I
know.
know. It's getting serious now, John.
Okay.
I guess.
Mind your P's and Q's.
Well, that,
Pints and quarts.
Is that what it is? I guess I didn't even really know.
Yeah, from drinking days.
Oh,
Hello.
well, I should know that then, huh?
Yeah, you look great.
Hello. Hello. Oh, look at Jen. Wow, you are repping democracy, pride, and what else? What's on your button today? Nice.
Yes,
Right.
love
Love
it.
it. That's right. You're running for city council. Talk about showing up and doing the work. Love to see it. Thank you,
Doing the work.
Jen. That's wonderful. Nice to see
Doing
you,
the work.
Ramona. Philip, my little ray of sunshine. Little
I
Santa Barbara in
wait,
the house.
I
Hi.
haven't been arrested yet either.
Oh goodness. I didn't know that was on the agenda. Is that a bucket list thing?
No, but every time I go to a protest, I wonder if I'm coming back alive or not.
Oh, okay. Well,
We'll bail you out, I
yeah,
promise.
we got you got our number.
Thank you. Yes.
so we should put you on speed dial?
Absolutely.
Yes, please.
And you have one call left. One call.
All right. Well, we know we have a passionate crowd here today. We're just letting a few more folks in. How is it already almost mid-July?
Ugh.
I mean, your guess is as good as mine. I think in some ways I'm thankful this year is going so quickly, but in others, it's just been a whirlwind. We're here to talk about how the markets are reacting to all that's going on in the world and to help us through that muddle of information is Brio's own John Clements, portfolio manager in the weeds, so you don't have to be. And then Brandon Miller here as well, kind of representing kind of client questions and concerns that he's been having over, during the recent times. So, and obviously this hour is for you as much as it is for us. So if you have specific questions, concerns, things you want some guidance on, the floor is yours. So just pop it in the chat, raise your hand, or unmute yourself and ask these peeps a question. All right. So with that, John, you want to give us a little brief intro as to what you're seeing out there?
Well, sure. I mean, first and foremost, Shannon, I'm completely on the same page with you. How is it July? Like, and it's not even to be like, yeah, we're post 4th of July. It's wild. Things are flying by, and I'm sure the last 3 months since our last conversation, as I remember, Brandon, I don't think we could have drawn it up any better, but I think our last conversation was literally 2 hours or 90 minutes or less before they announced
Oh,
Liberation Day. We'll put it
yeah.
that way.
Liberation Day, yeah.
As
You're
in,
right.
like, I think every single thing we said in that call was, this is what we know so far. However, start the
45 minutes.
stopwatch. In 45 minutes, this may be completely different. Um, then to no one's surprise, it was. Brandon, how did you feel with all that news flow that was coming through and just, you know, the penguins being insulted,
I know that.
islands being,
Yeah.
created out of Chat GPT.
Well, I mean, it really is like the noise, right? I know everyone makes fun of me because of my like giant index chart that shows like the past 100 years of investments, but like when you look at it like on that global scale, it's much easier to like see like what the noise is, right? And how like over time it kind of doesn't really matter. And then especially when the noise is about like, slapping tariffs on a nation full of penguins, like then you realize like maybe I shouldn't take this quite so seriously, right?
I'm not wearing it, but I did actually buy a shirt that said like support the penguins or something. It's in the mail. But yeah, that was what a wild time. What a wild time. Well, believe it or not, despite all the turmoil, upheaval, just uncertainty out there, the investment markets, I'm going to broadly say the investment markets because stocks, bonds, commodities, rare pennies, were pretty volatile. Pretty volatile. There was a lot of headlines coming out of the media around how dramatic some of these tariff announcements might be. The initial releases that came out quickly changed. There was is a lot of uncertainty. I think that's probably the best term to use around if these tariffs were reciprocatory, if they were, preemptive, what the definition of a trade deficit was. There's still a lot of questions around them. So as we definitely saw, it was a very scary period there for a bit. The equity markets actually declined nearly 20% quite quickly after the initial announcement. I think there was, when we last spoke, there was a lot of estimations as to what the scope and the breadth of the tariffs might be, and it turned out that the announcements were more broad and more severe than a lot of those estimates had predicted. So as a result, the equity market sold off dramatically. I mean, we saw it in everything from the biggest tech companies out there to small cap companies that would be most impacted by imports or exports. A lot of companies that have very tight and globally sourced supply chains, where suddenly their ability to get their inputs or get their products from overseas might be dramatically impacted, or the cost structure of that would be quite different than what they had budgeted for. And then, as Brandon just pointed out, the strangest thing happened. Believe it or not, for the quarter, stock market was up, and not up by a little. It was up by 11%, and that includes the drawdown from the tariff announcement itself, which, just given the uncertainty that's still out there, and you can't turn on the news without seeing some headline about tariffs have been postponed, or they've been implemented and then removed, and then there's been a trade deal, and there's been an agreement to have a trade deal. The news overload and the amount of headlines that are out there is just monstrous. So stepping back and looking at what we do know and the things we can tangibly look at and analyze, believe it or not, the second quarter of this year was the best quarter the stock market's seen in almost 3 years.
Wow.
Just wild. Wow. The last time we had a better quarter was the fourth quarter of 2023. And that includes, as I said, the market lows, which were on April 11th. And that's when the stock market had declined just about 20% from its February high and was down 11% on the year. So coming out of it, what we saw was technology stocks took off. They led the rally. And then surprisingly, industrials and consumer cyclical stocks also had the second and third strongest returns, which goes back to, once again, things Brandon has consistently said. I want to give him a billboard of this to put in his office one day. I think it would go really well next to the Republic of California. But it's that idea of trying to predict the market, trying to pick winners and losers, when you can look at a situation like this and say, God, things are so challenged, they're so uncertain. Anybody who's logically thinking through, okay, well, industrials and consumer cyclicals, which are going to be things tied to discretionary spending, would actually do really well in this environment when there's so much fear about unemployment, about inflation, about global trade grinding to a halt. There's a lot of persistence that's out there that's required to do this investing game. And I think this is just another prime example of trying to not overreact to some of the headlines that would come our way, as challenging as they may be. God knows I was in the weeds reading a lot of the analysis and the excerpts coming out of this stuff, but at the same time you can read about all the doom and gloom and then turn around and see, as I said, growth stocks climbing 20%. Can't say it intuitively makes a lot of sense, but this is the world we're in, and that's the reality of what happened last quarter. Now, a lot of that had to do with these tariff announcements being postponed, or there being carve-outs for certain areas, and we start seeing a lot of the political games that go into this. But the fact is that growth stocks did lead the way, as I said, up 20%. Value stocks, which had initially performed a little better than the broad market, given just cheaper valuations, did not match that rally. They only climbed about 1.5%. And then dividend stocks, which typically are associated with companies that have a bit more it's a loose term, but we're going to call it quality with their balance sheets because they have enough cash flow to actually consistently pay out dividends, rose just under 4%. So, when you look at this matrix of different parts of the market and how they moved, what it tells you is that, things that have the highest growth expectations and are, predicted to have dramatically increasing cash flows in the future, which is what growth stocks, get classified into, had the strongest performance of the entire marketplace, despite all that volatility and uncertainty. And then
So I think-
interestingly, there's only been 2 areas of the market that's actually down for the year. I know it seems odd, but and those two in this kind of highly risky, volatile situation might be areas that people would typically look to, and that would be healthcare and energy. A lot of times when you have inflationary environments, energy stocks tend to over a period of time match some of those inflationary pressures. And then healthcare is typically a defensive area where, should there be uncertainty in the market, the demand for healthcare is decently consistent. So a lot of investors look at that as a more defensive play. But nevertheless, despite all that, both those are actually negative returns in the year, while the rest of the market, especially those areas that a lot of folks would consider being much more front and center to this tariff topic, have performed quite well. Brandon, have you gotten a lot of questions about just kind of winners and losers and trying to predict what the tariff impacts might be across the marketplace?
Not really. Honestly, sorry, not really.
That's a good sign. That's good.
Questions are more like, just like big overarching, like, should I be scared? Do we what changes have you all made, or do I need to make, or like, do I care? I mean, I think at the end of the day, it's kind of like, I'm freaked out about the whole thing and I don't really know what to do about it.
Yeah.
Well, and to Vicky's question here, what's causing these anomalies? I mean, from what I've learned over the years from both John and Brandon, I feel is the market's going to market even if the world's on fire. I mean, is that
Yeah.
fair?
I keep trying to separate out like all the fears and anxieties. I keep trying to like parcel those between like the fears of democracy and freedom of speech and civil rights issues, and in the middle ground, like stuff that has to do with money, like Social Security or Medicare, right? That maybe I'm genuinely worried about. And to be clear, like freedom of speech, like scared shitless, right? Medicare, Social Security, like there are certainly issues there depending on your specific situation. And then there's like capitalism, and capitalism I'm not really worried about, right? To your point, Shannon.
Yeah, no, it's been fascinating. I wish I could say it was less volatile, but it seems like volatility and excitement kind of go hand in hand. One of the areas that's received a lot of questions and a lot of conversation about in the past couple of months, and I think a few folks have sent them my way, has had to do with the U.S. dollar. And it seems to be something that you hear a lot about on CNBC, you see it in the Wall Street Journal, but it's this question around, the government keeps talking about trade reciprocity and dollar strength and what is all this? What's going on? Well, so far year to date, we've seen
You were buying
the
stuff.
dollar, which
Oh,
it's kind of amorphous how you describe what the value of the dollar is, because if it makes sense, the dollar is valued against one other thing. So it's like dollar yen, dollar euro, dollar gilts, or dollar pound, etc. Now you can combine those into a basket and say kind of on average, because everything moves independently, what the value of that broad basket is. And so far, we've actually seen the dollar decline 10%. Now that sounds scary. It sounds like, oh my gosh, the US dollar just dropped 10% in 6 months. This is the sky is falling. We actually saw this only a couple of years ago as well, at the end of 2022 and into the beginning of 2023. The dollar also declined about 10%. So, it's true. What that means for all of us is our vacations to Europe or Japan or other foreign exotic destinations might be getting a little more expensive. And domestic travel might not be relative. But at the same time, that does ultimately, from a political standpoint, they're looking at it and saying, well, if we can decrease the value of the dollar a little bit, that makes exports a little more attractive for foreign markets. So, there's a little bit of a gamemanship there and what they're trying to accomplish with that. But sure, it does mean, as I said, some vacations might get more expensive. There's a lot of concern around foreign produced goods, and if that's going to make things more expensive, rightfully so. The fact is nobody knows yet. The tariffs keep getting pushed off. There's a lot of things that, despite the rhetoric that you hear out there, I think we were talking about this last week when I was in the office with everyone. You can't produce here. So a great example is Brandon and my affinity for coffee. Despite our best efforts, and the amount of coffee they can grow on the beautiful islands of the Hawaii and Kauai, you can't grow enough coffee to meet the U.S. demand.
Meet your demand.
Yeah, it's
Hey,
John's personal demand.
Just John's personal demand.
Actually, it's just mine. It's just
Can I
mine.
can I make a quick interruption though?
Yeah.
John, Ledoux, sorry, did you have a question?
Well, I was listening to the comment about the decreased dollar improving exports and things like that, but isn't that possibly countered by the counter tariffs we're receiving from these tariffs over, and making it more expensive not only to export, but for us in general to buy anything that's coming from overseas?
That's exactly right. That's what I was trying to get to, was
Kind of negates it.
yeah, no, you're exactly right. I mean,
Okay.
from the standpoint of, if the dollar's, relative to another currency is cheaper, that makes our exports in that market respectfully cheaper, assuming all things held constant, that they don't impose their own tariffs on those imports. From our standpoint, if the dollar becomes, we'll take Japan for example, the dollar becomes weaker relative to yen, Sony devices become more expensive, and Toyotas and Hondas, etc. So you're exactly right, and I mean that's the most confusing thing about all this. You can read the stuff coming out of Washington, or some of the really strong economic analysis on it, but there's just so many moving pieces that there's a lot of good modeling, but I don't think anyone truly knows the timing or the sequence of events as to how that would happen.
John, we've got some other questions here. If we have extra money to invest, should we focus on international places and markets?
That's a great question. I'm so glad who asked that. That's a phenomenal question.
Jen.
Wow, great job. I'll send you a thank you note later. That's a great question. So really interesting. So far year to date, and it's been somehow already 6 months, kind of like betting against the Harlem Globetrotters, the other team has finally won, or is winning. We'll put it that way. So I'm dating myself, but I grew up in the era of the early Simpsons, and I know, back before it was all CGI. And there was a phenomenal episode where Krusty the Clown was caught sports gambling, and his thing was, he goes, I was betting against the Harlem Globetrotters. And they go, well, why would you? They never lose. It's all rigged. Like, why would you ever do that? He says, well, they're due. The Generals were due. And that's kind of the situation we've seen with international equities, versus the U.S. over the last nearly 20 years now. And so during that period, the U.S. has lapped international, and as a result, U.S. markets have become quite expensive on a relative basis. And that finally changed this year. So for the first time in a long time, we've actually seen international outperforming, and not by a little bit. The last I looked, I believe U.S. is up about 6%, I want to say, year to date. I unfortunately don't have the exact number in front of me, but international markets were up nearly 20.
Wow.
And that's despite, once again, all this volatility, all this uncertainty, name calling, conflicts in the Middle East, I mean, too much. We don't have time in the call to even mention all the topics that have come up. But throughout that, we've seen international actually catch a bid. And so I'm a big fan and proponent of not avoiding international equities. There's many strong and world-leading companies that just happen to not be domiciled in the U.S. that are a strong, or a considerable portion of the international equity indices. And so as a result, we've seen some changes both on the fiscal side year to date, as we talked about some of the currencies, and then also from a regulatory standpoint, that has made some of the international markets more attractive for investors. One interesting thing I'd note about international is there's two ways to play it. One is, a lot of international investments are typically either hedged or unhedged. And what that just means is some vehicles will essentially just go by the underlying currency of a stock out there. We'll take Volkswagen, for example. And so if you're investing in an international unhedged equity investment, you would be going out, the fund would literally go buy euros and then go buy Volkswagen, and your return on Volkswagen would be, well, Volkswagen's return and the fluctuation of the currency. And there's a different approach to it, which is what they call hedged, which essentially means you go do the same thing, but then you also take a small portion of the investment and you buy forwards on the euro to remove the currency effect. And so there's two different ways to play it. We're much more at Brio a proponent of not hedging out the currency, because in a way that actually helps you diversify some of your dollar risk. And that way, when you have situations like this where the US dollar depreciates a bit, that actually does increase the return that you see out of some of those international investments themselves. The one other point I'd make about international is, believe it or not, the international equity markets as a whole are structured different than the US. I know it sounds weird, but when you actually break down what's in international markets, the demographics, the industrial and sector weights are quite different. So a good example is in the US, technology is currently listed as being about 31% of the entire marketplace from a market cap standpoint. Respectfully, in our conversations at Brio, we actually like to say it's a bit higher because there's some, I don't want to call it tomfoolery, but creative classifications around some names that are out there. So for example, Meta is considered a communications company. You tell me. Google is considered, Tesla is considered a consumer discretionary company. There's examples, I think Amazon as well is actually listed as consumer discretionary. So when you actually add a lot of these names back that we typically associate with tech, the actual index weight gets much closer to 45 to 50%. Now, international on the flip side has 10% only. And that's just a kind of a construct of what companies are based overseas and how large they are. And we've seen some other reverses as well, where in the US, industrials are only 9% of the marketplace, but internationally they're 20%. And financials are much bigger internationally as well. So they're just under 25%, while in the US it's about 14%. So just a couple things to keep in mind, because at the end of the day, if somebody's thinking, well, AI is going to lead the way, it's going to be Mag 7 and all this, international markets are going to be sensitive to those things in a different way than US, just given what's actually out there and its weights within that marketplace.
Hey, John.
Yeah.
So to think about it more from like the consumer perspective.
Yeah.
As I hear you talk, what I hear is like, I have no idea, honestly, half of what, not me, but like as consumer, no clue what the hell you're saying. Shannon, there you go. Yeah, Shannon actually probably is like, yeah, really, that's a lot of words. Should the consumer do anything any differently? I mean, I guess that's my question, right? Like Jen, my loving, adorable Jen, should she be doing something differently? Or like all the stuff you're saying is like, look, we have our asset allocation, don't go changing. Like just stick, like if you've got it right to begin with, don't mess with it.
Yeah, I think at the end of the day, if you're looking at the big picture, we say this every single day, the asset allocation is the most important component. And we have maintained an allocation to international equities over the past several years. And it has been challenging at times, but in periods like this where things start to move, maintaining that allocation has actually been quite helpful.
One of the things that I know this is like ultra simplistic, but let me run through a very basic example just to make sure that Keith, see it, got it. But one of the things I just want to make sure that people understand is like rebalancing, right? It's one of the things that we do. I keep telling folks, like as I've had these conversations for the past few months, is like, look, we do very boring, basic money management, in my opinion. And it is those boring basics that's executed super well and done with a ton of discipline on John's part, in order to make sure that this stuff all works correctly. But like an example of that is in February, we did a big rebalancing of the portfolios. Now, what that meant in practice was we actually, because the US markets, I'll just keep running with your example, Jen, because the US markets had been doing so well for the past, whatever, decade, basically, but we keep rebalancing it much more than that. But like, right, the US markets had run up, which meant now they were overweighted over the international. So basically, we sold the stuff that was doing well, the US stuff, bought the stuff that was not doing as well, the international stuff, to get it back into alignment. Right. So it's not like we went out and said, oh, here's where we're at with everything. Let's go buy a bunch of international. But in effect, because we just like keep sticking to our guns on the boring basics done really well, that is kind of what we ended up doing, right, in practice. And frankly, now, right, that the international has done really well, and the domestic has lagged a bit, we're probably going to have to rebalance back the other direction here relatively soon. Which again kind of goes against the grain for most folks, right? It's like, wait a second, that's the shit doing well. What are you doing? But that's exactly what we do, right? We just like keep going back to the boring, basic textbook answer of how to do proper money management. Is that fair?
So the takeaway is Brio's doing it. There's nothing that you
Kind of, yeah.
Okay.
I mean, you should always ask the questions. And like, there are times I think when clients want like to make a bigger bet in some direction, right? Like a lot of it is predicated on like wanting to like take action. But honestly, like so much of it really is action, often with human behavior being what it is. That action that you're like inclined to make is probably not in your best interest, right? So a really fun statistic is, if you look at the average investments rate of return versus the average investors rate of return, there's usually about a 3% gap. And it's almost entirely due to human behavior, right? And so, yeah, usually the best thing is to not do anything.
Okay.
Nobody
I'm good
ever
at
wants to
that.
buy something when it's down. You
Yeah.
look at, that's a really great study. I love looking at it because it comes out of Morningstar. It's constantly just basically saying it's a bit of a confirmation bias because nobody wants to go buy the hot fund that's down 20%. It's not hot at that point. They want to go buy something that's just trending up, that has a chart that looks like Bitcoin or something. And typically most investors are unfortunately late to that when it happens.
Yeah. It's all about not
John,
trying to time it. We got a couple questions here.
Yeah, I'm going to start pinging some of these. So John, can you talk for a second, again, just like big picture generalities? Peter's question around like, when do you think the US deficit starts to derail the bond market? Is the market disconnected from debt and deficit reality? Because I love this. And I think because I do think there's a fair bit of like how we think about our investments for the next, the short to midterm thing versus like, at some point, doesn't this crap catch up with us? Like at some point, doesn't the US fall off the leaderboard, right? Like, how do we play that?
Boy, that's a great question.
Yeah.
There's a lot of opinions on that out there. Everybody has an opinion on that topic. I would say first and foremost, this isn't new news. So full disclosure, I don't have a crystal ball answer, but I can try to articulate it in a way that I think speaks to what we're trying to do at Brio. First and foremost, this is something people have been talking about for 30 some years, at least. The issues with some of the entitlement programs, the impact on the federal deficit, persistent annual budget deficits, and what that does to the situation as well. There's questions around when is this going to happen? That's really, really tough to answer because people have been pointing to this for quite a while. They keep watching the debt to GDP ratio. There's been some really great analysis on that and kind of when things start going a little awry historically. There's a phenomenal author named Niall Ferguson who wrote a book on that actually a few years ago. Highly recommend it. there's a lot of concern about when debt to GDP ratios exceed 120, 130%, and what that does from a taxing standpoint, and then on total economic productivity. In this case, one of the things we closely watch is the yield curve itself, because that's ultimately the market telling you, well, here's what we think is suspect, and here's what we don't. And as we recall, over the past couple of years, we'd seen this really odd situation called an inverted yield curve, where short-term interest rates were higher than long-term rates. Sorry, I'm inverted on my screen. There we go. Which makes no economic sense. Like, why would anyone ever borrow money for 6 months or a year and pay a higher interest rate than somebody who's borrowing money for 30 years? And that typically is associated with this idea that the market's telling essentially the Federal Reserve and the bond market that there may be a recession coming down. That hasn't happened yet, knock on wood, but the yield curve has normalized, and so we now have a situation where things are pretty flat overall. And when I say flat, what that means is the rate that people are charging to borrow for 6 months or 2 years is not far off from what you would see for somebody borrowing for 10, 20, 30 years. So right now, we have a situation where the cost to borrow for 2 years versus the cost to borrow for 10 years is only 56 basis points different, so 0.5%. When a lot of commentators on the subject like to point to what they call the long end of the yield curve. And what that means, that's the area with bonds that mature beyond 10 years. So 10, 20, 30, 50. There's even some 100-year bonds out there somewhere. And what they like to look at is they say, well, what's the cost for somebody to borrow that? And so the idea of that is, if the investors think the fiscal situation in the US over a longer period, take say 20, 30, 50 years, is more precarious than it would be over the next 2, 3, 4 years, they would demand a higher interest rate. And what we would see is we'd see long-term yields go way up. So right now, a 30-year bond is yielding 4.75, so less than 5%. Now, if we go back and we think about the 80s, we think about periods where interest rates were quite high. We saw interest rates in excess of 10%. We would expect that figure to go up quite a bit as the quote unquote fiscal situation became more precarious. So I don't have a great answer on to when that timing is, but there's definitely signs to watch for. That would definitely be one. The other thing that a lot of people like to watch is what they call treasury auctions. And if that name in of itself doesn't put you to sleep, I don't know, like that's phenomenal. Treasury auctions are incredibly boring. It just means people show up and they bid on government debt. And there's a concern out there that what happens when people stop bidding on debt? Basically somebody's trying to, you picture, the auctioneer trying to sell cattle or something, or my dad loves classic cars, Mika Moto Show. I don't know if anyone watches that, but somebody says, hey, I've got a 1965 GT 350 Shelby. Who wants to buy it? And nobody shows up and says, I want to buy it. They're going to end up having to sell it for less. So that's the same idea, where if there's people backing away because they don't trust the government essentially over a longer period, you would see, and that would once again be reflected in the yields themselves. So we would see the yields on 30-year bonds go dramatically up relative to other parts.
I have one kind of quick anecdote, maybe more than anything else, which is while just around long-term, the US versus other markets or whatever, I just always have it in the back of my head. I remember when the US was first downgraded in credit quality.
Oh yeah.
For the Great Recession. That was so to me, it was such a momentous occasion. And clearly what should have happened, right, is the rest of the world should have freaked out and been like, goodbye US of A. But instead what happened, everybody was like, oh, if the US is in that bad of shape, just imagine how bad everybody else must be. And then they started piling into US debt and buying even more of it. It was the exact opposite of what I would have predicted, right, if I was trying to predict the future, which is exactly why I always try and say, please, I don't care who you are or what you're doing, do not try and predict the future, because you just never really know how it's going to play out. Okay.
Yeah. Yeah. And
Right.
at the end of the
Oh.
day, it's one of those things that you go, you know, what else are people going to buy? The
Yeah.
U.S. government's the biggest debt issuer in the world. There's going to be a price people will pay for that debt because there's so much of it out there. And it's such a fundamental tenet to the entire global economy that, if people just stop buying it, what else would they buy?
I'd be happy to auction off some of mine. If that's an option.
We could do an auction
Hey.
at our next call.
All right,
Hey,
excellent.
let me
We got a
address
lot of
one of the
questions about the
questions.
BBB.
Yeah, and let me do one of the quick like rebalancing because we were talking about rebalancing earlier. So just to like answer that one real quickly, there is some degree of regularity to it, although I will say that mostly what it amounts to is the rebalancing needs to be what really matters in terms of rebalancing is the dislocation between asset classes. And so if to be again ultra simplistic, if I had a 50-50 portfolio and stocks went up 10%, but bonds also went up 10%, we would still have a 50-50 portfolio, right? So it really depends on like how one asset class has performed versus the others. So that's one part of the like when to rebalance. The other piece of it is there's a fair bit of like tug and war. I think, John, correct me if I'm wrong, please. But I think there's a fair bit of tug and war within the industry as to like you also don't want to rebalance too frequently because you do want to let your winners run a little bit, right? Before you like, handicap into the knee. So yeah, like ultimately I think we usually, and I would say it ends up being about like twice a year often that we do rebalance. But again, it totally depends on like the markets and kind of how volatile they are compared to each other. Good?
Yep, love it. I'd say once to twice a year. And then if there's a big dislocation like we saw in
Yeah.
April or beginning of the year, you're exactly right. You got to let the winners run. So you can't just say, oh boy, if something's up, 2%, we got to rebalance it. You go, well, that's not actually moving the needle. We need to be able to allow things to grow over a period, but grow in a risk managed way.
Hey, on charitable donations in 2020, I'm going to pivot a little bit and just start answering a few questions just to make sure we get through some of it. One, just to be like totally transparent, I am not the expert on this tax bill yet, but we'll get there. But I think I can get most of these. In terms of the charitable donations in 26, there are a couple of changes to it. Probably the one that will impact most people, because mostly what happened with this tax bill is just that it continued a lot of the crap that went through back in 2017. Okay. So in 2017, what happened is they vastly decreased the number of folks who itemized their deductions. So they took what was the standard deduction way higher, and simultaneously, they took a lot of what we were deducting and dropped those down, right? So I literally think like, I forget the numbers. It was like 70% of the population who used to itemize no longer itemize, right? So it's a big chunk of the majority. And that, again, basically just got extended, and even kind of more so, they kind of pushed it a little further in some ways. So with, just know, like if a married couple, the new standard deduction is $31,000. So if you don't have more than 31K or exactly half of that for singles, but married filing joint, I think it's at 31 now. So if you don't have more than that, it doesn't matter if you donate or don't donate, right? You're not going to itemize it. What they did do, though, is for folks who do not itemize, you're now allowed like just a gimme, if you will, on the charitable deductions. And so you can do what I think it's $1,000 for singles, or $2,000 for married filing jointly, I believe. Yeah, $2,000 for joint, $1,000 for individuals. And you can still itemize that for charity, even if you don't itemize on like a Schedule A. Does that make sense? I don't know if I said that super clearly. Okay, all right. That's the biggest piece of the puzzle. For those folks who are giving more money than that to 501c3s, remember the political stuff doesn't count. But if I'm donating to 501c3s and you're giving more than the 1 or 2K a year, and you're not itemizing, it's not getting you, if you're giving more than that and you're not itemizing for other purposes, then there is a bit of a workaround, which is like bunching of deductions. And so we might bunch, meaning we might donate 30K this year and then not donate again for 5 years and then donate 30K and then not donate again. And we usually use a donor advised fund to accomplish that, but that's just one piece of it. Okay. That was one part. There was another, I think there were other.
The US labor market due to pressure on immigration and increased detentions and deportations.
Yeah, I'm not really sure how to answer that, Keith. I mean, I don't think there's anything necessarily in the tax bill that really speaks to that piece of it. I mean, clearly, John, like obviously there are massive sectors and industries that rely on undocumented labor, and whether we're like physically moving that many more people out of the country, or if we're just like scaring the bejesus out of everybody so that nobody wants to come here, the effect I think is somewhat the same. Do you have any comments, John, about like succinct comments around, you know, kind of, is that really going to impact things like housing and?
Yeah, it's a bit of the chicken and the egg, because a lot of the people that this is directly impacting aren't considered in many of the standard economic data indices essentially that are out there. So when you look at the unemployment rate, does the unemployment rate consider people that might not be here legally, that might not be getting paid, over the table? So there's some wiggle room on that as to if some of the common metrics actually are picking up any of this. There's been a lot of commentary from some of the home building companies on it actually, and talking about challenges that they're running into, both on the input side, so getting the lumber, getting raw materials and things, and then just challenges with workforce management. I personally haven't seen anything yet out of the food processing industry, in the agriculture industry, yet, but I anecdotally have some family members in that industry, and it's very much top of mind for them as a challenge. So, a lot of these data points and things that we get on the portfolio side are typically delayed, frankly. I mean, because this stuff won't come out until an earnings call 3 months afterwards or 6 months afterwards. So I personally believe there probably will be some impact from it, but I don't know if we'll see the quantifiable portion of that until sometime later. Can I add one thing on the Build Back Better while we're at it?
Yeah.
It's build back. It used to be able to build back better, and now we're at big beautiful bill.
Yeah, it's too many B's. Sorry.
I know.
Triple B's. There's obviously a ton of things in this that covers a variety of topics, but there's two in particular that I just want to highlight because of what they did not change. And I think as many changes as there are in it, looking at what did not change also can be quite valuable. And so the one that jumps to the top of the list is the municipal bond industry. There was about 2 months ago, there was a ton of conversation. It was once again on CNBC. It was all over the place about the fact the administration was looking at reducing or ultimately eliminating the exemption for municipal bond interest, which would have frankly turned the country upside down. And as many of us know, essentially municipal bond interest becomes double tax exempt. So if you are buying bonds for the Bay Area Rapid Transit Authority or the Bay Area Toll Bridge, which is the Bay Bridge, the interest from that is is exempt from both federal and from state income taxes. So if this had gone through, it would have been a nightmare for the entire public municipality throughout the country, because essentially to finance themselves or to do any capital projects, they would have to issue debt that has a materially higher interest rate to be competitive in the marketplace. So by doing this, and by not doing this, sorry, it maintained the status quo, which frankly has been working, has worked now for decades and decades. And I think it's quite important to note that despite all the rhetoric and some of these the uncomfortable comments made about it, that was not included in the bill in any portion that I've seen or in conversations I've had with folks. The other area I'd just point to is capital gains. There was some question about would capital gains be changing one direction or another, and everything I've seen has pointed to that even in some of the small footnote text there hadn't been any changes to that itself, which would be directly applicable to our portfolios.
Okay, there's some other questions. Does it affect PTEs, which Google tells me is pass-through entities?
Oh. I think like by and large, the answer is no. What I'm not really sure if Maryland's getting at is the pass-through entity tax, the workaround. One of the big issues in the previous one was in gifting stuff. Okay. One of the big issues around the old one was the SALT cap, the state and local tax cap, right? So whatever it used to be, that whatever you paid to your state, whether that be property taxes or DMV fees or actual state taxes, you could deduct those on your tax return, on your federal tax return, right? And then in 2017, there was a cap of $10,000 put into place. So the state and local tax cap of 10K. And that hurt, of course, states like New York, California, New Jersey, states with big taxes, essentially. So clearly, a nose to the Democratic states. That got lifted this time to 40K. So the new limit there is $40,000 on the state and local tax cap. There are limitations of that though. So if you make more than 250K single, 500K married filing joint, then they start decreasing that SALT cap. So there are some issues with it if you're a super high earner. I will say though, on the pass-through entity, so a lot of folks use what's called the pass-through entity tax. If you have any kind of self-employment income, you can have that essentially business pay those taxes and you're not capped. And so that's been a workaround for a lot of folks. And that did not get touched in this bill. They assumed it would, and it didn't. So if you're using the pass-through entity as the workaround, you're still safe.
Okay. How about opportunities or risks from current Fed policy or U.S. market for bonds and treasury bills? Yes, John.
Hi, I'd like to take that one.
Good.
What a time to actually see the federal chairman, or excuse me, the chairman of the FOMC be just raked over the coals by the administration and people telling them they're sinking the ship and all these things. It's the Fed policy right now is entertaining. It's not quite Game of Thrones entertaining, but it's up there. And it's fascinating just to take a step back and look at this, because the most important thing to remember throughout any discussion on interest rates and what direction they're going is the idea that the Fed is supposed to be independent from the government. This is not new. This was originally written about during the French Revolution. It was a very principal idea a couple hundred years ago. And so there is supposed to be a tension between the government and the Fed, because every government wants easy money. Every president wants low interest rates. They want the economy firing on all cylinders, and nobody likes the person who takes the punch away from the party, or person who doesn't let the punch come out even. And so that natural tension is normally always there. It's been there for quite a while. Even recently there was some discovery of the Nixon tapes, and they actually have recordings of him chiding the Fed back then as well. But it just hasn't been as public as it more recently has now. So before we just go into like direction of interest rates or anything like that, just to kind of highlight like a discussion Brandon and I had, which was about, well, does the Fed chairman actually decide interest rates? You can sit there and say, Jerome Powell, this guy's a clown. This guy doesn't know what he's talking about. Never mind, Trump appointed him first time around. It's fine. But the fact is no, the Fed doesn't. The FOMC is a committee. It's a committee of 12 members from around the country, and they vote on this. So it's not just one person saying, we're going to raise rates, we're going to lower rates. There's 12 very informed, highly respected individuals that are actually making this determination. And it's not just a symbolic thing where all 12 always vote in one direction or the other. You actually do get dissenters in a vote when they might not agree with everything. So and it's all recorded. So, so there's pretty good historical reference to the fact that, when the committee votes to move interest rates or not move them, sometimes not everybody agrees. Now, just recently, we had the committee come out and say, we're going to not move again. All 12 members agreed. There was no dissent. So it's not just the Chairman Powell saying, we're not doing this. I'm going to, I got to keep face or something like that. It's backed up by multiple multiple people on the committee itself. Now, right now where we stand, interest rates are 4.25 to 4.5. We're down 100 basis points from where we were last fall when they were at 5.25 to 5.50. Excuse me. The thinking behind this is that the Fed, in their comments, has come out and said, look, we would have cut rates except for tariffs. And we're watching for the tariffs, which, as we talked about earlier, were announced, but have not been fully implemented or are still being negotiated or still in flux. We're waiting for those to work through the system because they don't just happen overnight. So the idea there is, should there be any inflationary pressures that actually do work through the system, they would have the bandwidth to be able to hold rates where they are or even potentially increase them. But should there not be any inflationary pressure or unemployment starts going up from its current 4.1%, they have also the bandwidth to then cut rates and try to help stimulate the economy from that perspective. The consensus out there right now is that rates will be going down directionally, but there's a lot of discussion as to how much, when, and will all interest rates go down. As we talked about with some of the government debt questions, it's very possible that even if the Fed decides we're going to cut interest rates by 25 or 50 basis points in September or in the fall or in the early winter, that might bring down short-term rates, but it might not actually move the 30-year rate. So the important thing to remember is the Fed only controls one interest rate, actually, just one, and it's the overnight rate. They don't control the 2-year rate. They don't control the 5-year, the 10-year, or the 30. They only control the overnight one. And that has a lot of bearing on or a lot of impacts on the rest of borrowing and interest rates out there. But that's where the market comes in and actually determines the risks of maturities longer than overnight. So, ultimately, the understanding is that the Fed has made comments that they do think rates are a little restrictive right now, which is their way of saying that, yeah, they're high. So directionally, they should be cutting them, but we'll have to see how much. The current expectations are for September for somewhere between 25 and 50 basis points, but that's just an estimate based on what the market's pricing in right now.
Thank you,
And I would
John.
let me translate that a little bit further for like mortgage stuff, just because a lot of the stuff I'm dealing with clients is around mortgages, right? And the interest rates there. Yes, mortgage rates are high. They feel incredibly high, and certainly they are compared to what we've been used to. But when you look over the last 40 years, they're not that high. They're darn close to the average, right? So, I mean, I would say if I were betting, I actually would bet that mortgage rates go down in the not too distant future. And to some degree, this is the new reality, right? So I don't know that I would get you're not going to get a 3% mortgage again in our lifetimes, right? I mean, who knows? Maybe another COVID comes along or something, but right, don't bet on it.
Yeah.
I'll say it.
Well, I think he actually took off, but Philip asked any changes in gifting and also in gifting stocks or bonds.
No.
No. Oh,
Easy
there he
answer.
is.
No.
There he is.
The only thing I would say is the estate tax exemption did become permanent at 15 million or 30 million for married. So more than 15 million, we got to worry, or 30 million if you're married. Beyond that, no estate tax. I think you're safe, Shannon. Barely, but safe. The annual exclusion amounts remain the same, 19K. It is indexed for inflation, so those will continue going up. And it doesn't matter what you give, just for the record. Like if you give stocks or cash or gold, nobody cares.
All right. Any final questions for the Brio twosome?
I will point out one of the things, just real quick, because I have a couple of seconds. Our and this is like a big generalization, right? So look at your own stuff or talk to me or whoever your advisor is, whatever. But like our in kind of like when the shit really hit the fan, I think again, John, correct me, but I think the S&P was off by about 15% at its worst. The NASDAQ was off about 21% at its worst. And most of our clients, their portfolio was down about 4%. And again, I would love to say that John is like Einstein over there predicting the future, and he is Einsteinian, but he still can't predict the future, right? It really is like the boring basics done incredibly well. And all of that, like it did what it was supposed to do. The rebalancing we do, the tax loss harvesting we do, like all of those things, the asset allocation and diversification that we really, really, really hammer home, like it worked, and it worked really well for most folks. And then on the flip side of it, what's cool is like as the markets came back, your portfolios on the whole like stuck right there with it, right? So this last time I did a meeting, it was because I'm on vacation, it was like a week ago or something. But it was like I think the S&P was up 5% and the client's portfolio was up 6%, right? So it's I will say the money management piece of the puzzle has been so much better than what people have been thinking or feeling, right? One, I think the news is scary, right? And I think for many of us who maybe might blame a certain person in the White House for a lot of the issues, you know, of the stock market, like I think it was easy to kind of pile onto that. But the truth is like, it wasn't as bad as you thought. And then the portfolios actually performed exactly the way they were supposed to, which made it a whole lot better than anyone kind of was expecting. So I'm super proud kind of how everything has been the last 6 months, I would say. I'm super proud.
But this just does land a little different with you with that flag in the background.
Sorry.
Are you going to declare your running mate, Jen?
Exactly. Totally.
All right.
Brandon, at the end of the day, I think it bears repeating. Diversification works.
It works.
It's
so
boring.
simple.
Bears
It's boring, but it
repeating.
works.
Point to the bear, Brandon.
It's so simple and it works. So like, don't try and overthink it.
All right, all. Thank you so much, folks. And stay tuned for John's monthly investment corner email that goes out and kind of gives you in between these calls updates. Thank you all for spending some time with us. We'll see you soon.
Bye. All.